Friday, February 11th, 2022, Monaco 64, home of alternative economics and contrarian views. So today we're going to look at whether the Federal Reserve can engineer a soft landing for the U.S. economy, for the world economy, for the financial system. Yes, it's all touch and go. And we're going to look at a couple of scenarios that are possible, in my opinion. And this applies, of course, for all the other major central banks. They're going to have to go along with what happens in the U.S. After all, the whole system is underpinned by the Federal Reserve. Before I start, though, I like to give you a little bit of background on me and why I'm, you could say, obsessed with what happens in terms of inflation, obsessed with the nature of money. I'm not obsessed with money. Yes, I'm really obsessed with trying to inform people about inflation. Well, one of the reasons for that is that I grew up, I was born and grew up in Brazil. And in Brazil, inflation has been something that people have lived with. And I remember growing up, and I was one of the lucky ones to be on the right side of the fence, so to speak. If you want to go to a country and see what wealth inequality is, you go to Brazil. And I always wondered when I was younger, you know, why? Why is this family so poor? You know, and why is this one so well off? You know, I couldn't understand it. And of course, with time, I grew to understand why inflation is such a heavy burden on the general public, especially those at the bottom of the economic ladder, so to speak. And that's one of the reasons why I feel it's so imperative to try to inform the public about the evils of inflation. And unfortunately, this is not the first time that it's reared its head in Western Europe. And I think, yeah, with that, we're going to look at the Fed now, whether it can engineer a soft landing. So yes, yesterday we had the CPI data. And notice I don't call it the inflation data because the inflation has been created already by governments and the central bankers. The rising prices are not inflation. They're the consequence of inflation. And that's why I think we have a problem. And going back to where I grew up in Brazil, I was watching the other day a series about Imperial Brazil from the early 1800s. I found they're called like novellas in Brazil, but I found the videos on YouTube. And there's a scene there where a guy who owned the bar told a customer who wanted to drink on credit. The guy said, "A promise doesn't pay the bills." And the other scene I saw was John VI, who was the king of Brazil. Well, he was a regent king of Portugal, became the king of Brazil. He's talking to one of his ministers, and they have a rebellion in the northeast of Brazil. And King John VI said, well, just melt some of those silver coins and multiply them. And when I heard that, I thought, wow, that's inflation, and that's government, because they were in debt and they had a rebellion on their hands. They couldn't pay their bills. So what do? Well, you melt the silver coins. How do you multiply them? Well, if they're 90% silver, you multiply them by 2 by taking half of the silver out of the coins, reminting them, and they still look like normal coins with the same face value. And that's what he meant. And that's what has been done to our monetary system since '08. Why? Well, because our governments have had to bail out the banks and they've had to keep bailing them out, yes, and they've had to bail out the whole of the economy as well with COVID, and Wall Street as well, of course, another time with the repo crisis of 2019. So hopefully that gives you an idea why I'm so concerned about these things. So there's an old saying about someone being behind the curve, like you're a bit late. I actually think the Federal Reserve doesn't even know there's a curve at this juncture. They're starting to realize maybe there's a curve. We saw James Bullard yesterday. He's the mouthpiece of the Fed now to try to control things. He's the St. Louis Fed president. He actually said we might do an intermeeting hike. Well, it's about time, Mr. Bullard. I've been saying that for over a year because the CPI and prices have been rising already way above their target of 2%. And I've said, how can you keep rates at zero? How can you keep doing QE when the CPI is running at 3, 4, and 5? And now we're running at 7.5. So maybe they're starting to see the curve, but they're way behind the curve. As for a soft landing, there's a chart here you can see, and I took this from goldsilver.com, the Fed paradox. Necessary rate hikes inevitable equals inevitable crisis. It's from February 2018. So it shows you here the Fed funds rate, and every time the Federal Reserve embarks on a tightening cycle, and they haven't even started tightening this time, they're still at zero. And I think CPI has been above 5% for 6 months or maybe more. They're really holding off because they can't raise rates really without causing a big accident. So you can see here, prior to the '29 crash, Federal Reserve raised rates. They raised rates in the early to mid 30s, and then there was a 37 Fed policy mistake. They raised rates in the from the mid 60s until the late 60s, and they had a Penn Central Bank collapse in 1970. They raised rates from let's say early 70s to 74. Franklin National Bank collapsed, and these were, of course, absorbable. They didn't cause that much trouble. They didn't reverberate throughout the world. And then you had the Volcker rate hike cycle from 79 to 81, where rates went to 20%. And you had the Latin American debt crisis in 82, and I remember that well, being in Brazil at the time. 1982 is the year that I went to university. So I was coming back every year for vacation in Brazil. And I can remember it wasn't a good time for the country economically. And then you had a stock market crash there. As you can see, they raised rates and the market crashed. They raised rates also in the early 90s, and you had the SNL crisis, the tequila crisis. That was the last time the bond market as well had a really bad bear market in 1994, and remember that well. The tequila crisis was when they had to bail out Mexico, I think, the US Treasury at the time. And then you had also the Asian crisis, 1997, 98, the tech bubble as well. And then the big one, the subprime crisis and the collapse of Wall Street. Why do I say collapse of Wall Street? Well, because it would have collapsed weren't it for the bailout of Wall Street. And we're still paying for that the old story about melting the coins to pay for that bill. And they tried raising rates again from 2018 or so, 2017, 18. Well, they started really slowly in end of 2015, and then all hell broke loose, of course, in September 2019. That's when the crisis really started, and it was a repo crisis. It was a crisis of confidence amongst Wall Street institutions. And of course, the COVID crisis was a great excuse to come out with even more bailouts. And this time they had to bail out everyone, because you would have had a revolution by now from Main Street if they hadn't been bailed out as well. So yeah, so that is the question now. A lot of Wall Street analysts, and I don't watch the mainstream media like CNBC or Bloomberg or Fox Business, but there must be a lot of, and I think there is, because I follow Twitter, a lot of people think that the Fed can actually engineer a soft landing, that there won't be a big crisis. I have to say that that's wishful thinking. So what are the two things that can happen? Well, I think we can either have a total liquidity collapse, a crisis of confidence in terms of, yes, the viability of banks, the viability of corporations. And why is that? Well, because the Federal Reserve is losing control of the bond market. We saw yesterday the short end to the middle of the curve, like 2 to 5 years, yields rose by 20 basis points, which is basically unheard of, very rare that happens, especially in the so-called risk-free market, risk-free, which treasuries are supposed to be. The 10-year, of course, was up about 10 to 12 basis points, up to 2.05. And what that means, as you can see here by John Exter's pyramid, and I won't go into John Exter. I will put a few videos up in the cards. I've spoken about him many times before. So this is how he saw the system unraveling. You would have, and he didn't have derivatives at the time. This is a modern version of his pyramid. He died about 12 years ago, or maybe more, John Exter. And you can see how gold, and I would add silver, is at the base of the pyramid. And then you have paper money, which is what they call cash nowadays, the Federal Reserve promissory notes and the Bank of England notes and the Euro notes. And above that, you have government bonds and treasury bills. So, and above that, you have the corporate bonds. Bond markets, people don't really look too much at them. The stock market is the place where people focus on, at least for Main Street and private clients. But the problem with the bond markets, and we're seeing a lot of selling now, especially in treasuries, and it's going to be worse in the corporate bonds and the junk bond market, is that the whole system is backed by government bonds these days in the fiat currency system. And if the Fed loses control of the market, it loses control of the inflation situation, people will start selling treasuries. It won't become a risk-free asset anymore. And the more you sell treasuries, of course, the higher yields go. And what we've had since 1980 is we've had a bull market in the price of treasuries and bonds because rates have been going lower and lower. Yes, there have been corrections up in yields, but they've been controlled. So they've stayed firm. Government bonds stayed firm. And I know this from experience, working in the city with institutional clients. A lot of times they didn't leave cash with us. They left treasury bills, treasury notes as collateral. So if the whole collateral for the financial system starts losing value, everything above that is leveraged, like the corporate bonds, the equities, real estate, derivatives, unfunded liabilities, all that will unravel. People will have to sell all the stuff above the pyramid to basically cover their liquidity. And you could see all this paper wealth evaporate. And look at what's at the bottom of the pyramid. Well, it's gold and silver. Some people might argue that you should add Bitcoin. Well, that's another question. So I think that could happen. That would be a deflationary collapse. We would see basically Exter's pyramid come into effect. And that's what he thought would happen. What's the other alternative? The other alternative is that the Fed sees this pyramid unraveling and they backtrack and start inflating. By inflating, I mean cutting rates again and doing more QE. And then you're going to get a total loss of confidence in the currency. And that's hyperinflation. And hyperinflation means that anything denominated in dollars becomes pretty much worthless. And in that case, you want to have tangible goods. You might even want to have stocks of companies that are involved in real things, that produce real things. But a lot of the financial stocks, even technology, everything will unravel. So that's what I think is going to happen. That could happen, these two scenarios, if there's an accident. Of course, there's a small chance that they do a soft landing. And actually, I wouldn't mind seeing that, but I just can't see it with the way things are. So with that, let's quickly look at where the markets are this morning. It's just gone past 9 a.m. London time. We've got spot gold trading up just about $1. It's trading at 18.27. High has been 28 and the low has been 18.21. We spoke about gold yesterday. And as I said, I wasn't saying gold and silver are going to break out yesterday. But I still haven't changed my mind about gold and silver, especially hopefully with what I showed you today. You realize how important gold and silver are in these uncertain times. So nothing's changed. The bigger picture, the long-term picture for gold and silver. I think gold got up to 1842 yesterday, got down as low as 1820, just like overnight. Silver got up to 2370. Silver was hammered a bit more towards the end of the day, unfortunately. But that's the way it goes. Silver right now is down 16 cents at 23.02. The low actually has been 22.85. So we're back above 23 right now. The stock market had a tough time yesterday, especially after Bullard came out. And we continue to see the market lower. The Dow is down 0.5%, 150 points. NASDAQ is down 100 or 2/3%. And the S&P future is down 0.5% or 25 points. FTSE is down 70 points or 1% at 76.05. The currencies, the pound and the euro rallied strongly yesterday, and then they fizzled out towards the end of the American trading day. Right now, the pound is 135.58, unchanged. The euro has moved quite a bit. We went up to almost 115, and we're now at 113.90. It's down 1/3%. So a lot of volatility. I think the dollar came back a bit because there's speculation that the Fed could actually raise rates today before the markets open. We'll have to see. The dollar's up slightly versus the yen at 116.05, and the dollar's down slightly versus the yuan at 636. Aussie dollar. Aussie dollar is down 0.5%, 71.30. The dollar is unchanged versus the Canadian dollar, 127.25. And the Kiwi dollar, let's see where the Kiwi dollar is, if I can find it here. Kiwi dollar is down 0.25%, 66.53. Yeah, the commodities, general commodities, crude oil, still relatively firm, 89.07, up 0.25%. High-grade copper has come off quite significantly overnight. We're down 2.5% at 4.54. What about the 10-year yield? Well, 10-year yield has come off a little bit. It's down 3 basis points, right at 2%. And yeah, we could see actually the longer end of the Treasury curve rally, not in terms of yields, but prices. We could see yields come off if the Fed does raise rates today, because investors will probably think that maybe the Fed is serious about fighting inflation, and that helps the longer end of the curve usually more. I think that will be temporary. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day and a great weekend. Take care. Bye.